Imagine this: you wake up, check your portfolio, and see a number so low it feels like a physical blow. That's exactly what happened to one Ethereum trader very recently, a story not of a lucky break but of a devastating, multi-million-dollar lesson written in the unforgiving code of the blockchain. This isn't just a rumor or a piece of market gossip. This is a concrete event, a transaction that was verified and recorded on the public ledger for everyone to see, a cautionary tale etched in digital stone. According to the on-chain analytics platform PANews, a specific leveraged position on Ethereum, one that was initiated with immense confidence right after the sharp market decline on October 11th, has just been forcibly closed. And when we say closed, we mean liquidated, wiped out, terminated with extreme prejudice. The key detail, the one that should send a chill down the spine of every single person watching this video who has ever even thought about using leverage, is the sheer scale of the loss. We are talking about a position that lost over $8.5 million. Let that number sink in for a moment. $8.5 million. Gone. Not over a period of years, or months, or even weeks. This was a position that was opened and then annihilated in a brutally short span of time, a testament to how quickly the markets can turn against you when you're playing with borrowed money. Now, I want you to do something for me right now. I want you to hit the pause button on this video, go down to the comments section below, and just type the word leverage. Go on, do it. I'll wait. This is important because we need to acknowledge how many of us are flirting with this same kind of danger. This story isn't about some anonymous, faceless whale. This is a parable for the entire crypto space, and your comment will be a powerful reminder to yourself and everyone else watching just how prevalent this tool is. Welcome back. So, let's deconstruct exactly what happened here, because if we don't learn from this trader's catastrophic mistake, we are doomed to repeat it. The sequence of events is crucial. On October 11th, the price of Ethereum experienced a significant drop. For many, this was a moment of fear and panic. But for this particular trader, it was a signal. It was an opportunity. Their analysis, their gut feeling, their entire trading thesis in that moment screamed one thing: this is a bottom. This is the dip to buy. But they didn't just buy. That would have been one thing. Buying the dip with your own capital is a time-honored, if still risky, strategy. No, they decided to amplify their bet. They used leverage. They essentially borrowed a massive amount of funds to multiply their buying power, opening a long position, a bet that the price of Ethereum would not only stop falling but would roar back with a vengeance. In their mind, they were a genius, buying fear when everyone else was selling it. They were going to be the hero of their own story, the trader who bought at the absolute bottom and rode the wave all the way back to the top. The problem is, the market doesn't care about your story. The market is a chaotic, unpredictable force that respects neither genius nor desperation. The position was opened, and for a brief, glorious moment, perhaps it even went into the green. We can imagine the confidence, the feeling of invincibility that must have washed over them. But then, the market did what the market does. It didn't rebound. Instead, it chopped. It moved sideways. It dipped again. And with every slight downward tick, the pressure mounted. A leveraged position is like being on a timer, and that timer is fueled by your collateral. The value of the Ethereum they had put up as collateral to secure this massive loan began to shrink, inching closer and closer to the dreaded liquidation price. This is the predetermined price level where the exchange or the lending protocol says, enough is enough. They don't ask for your opinion. They don't send you a polite email. They have an algorithm, a cold, unfeeling piece of code, whose sole purpose is to protect the borrowed capital. And when the market price of Ethereum finally touched that liquidation threshold, the algorithm swung into action with brutal efficiency. In a single block, in a matter of seconds, the entire position was automatically sold off into the market. The trader's collateral was seized to repay the loan, and any remaining value, if there even was any, was vaporized by the liquidation penalty and the ferocious market sell-off that these very liquidations cause. One moment, a multi-million-dollar position existed. The next moment, it was a line of code in a blockchain explorer, a digital tombstone marking the final resting place of $8.5 million. The most haunting part? This entire process, from the initial confident trade to the final, catastrophic liquidation, was entirely automated and utterly emotionless. There was no time for a desperate margin call, no last-minute chance to add more collateral, no heroic save. It was just over. And that is the single most important lesson you must take away from this story before we move on to the second part of our deep dive. So, the dust has settled, the blockchain has recorded its verdict, and one trader is now $8.5 million poorer. But if you think this story ends with that single liquidation, you are dangerously mistaken. This event is not an isolated incident, it is a symptom of a much larger, systemic force that actively shapes the market you and I are trying to navigate. The aftermath of a liquidation of this magnitude creates a ripple effect that impacts every single person holding Ethereum, and understanding this chain reaction is what separates informed participants from cannon fodder. Let's talk about the liquidation cascade. When that trader's position was automatically sold off by the protocol, it wasn't a quiet, orderly transaction. It was a fire sale. A massive amount of Ethereum was dumped directly into the order book at the market price, whatever that price happened to be at that exact millisecond. This sudden, enormous influx of sell pressure does one thing with ruthless efficiency: it drives the price down even further. And here's the terrifying part: this new, lower price now threatens every other leveraged long position that was hovering just above their own liquidation thresholds. Imagine a row of dominoes. This $8.5 million liquidation was the first, heavyweight domino that tipped over. It crashes into the next one, which might be a $5 million long position that gets liquidated because of the resulting price drop. Then that $5 million liquidation sells off, pushing the price down further, triggering a $3 million position, then a cluster of $1 million positions, and so on, and so forth. This is the dreaded liquidation cascade, a self-reinforcing feedback loop of financial destruction where liquidations beget more liquidations, creating a violent, exaggerated downward spiral that has very little to do with the fundamental value of the asset and everything to do with the mechanical unraveling of over-leveraged bets. This is why a relatively small move in the overall market can sometimes feel like an absolute crash. It's the leverage being purged from the system in the most violent way possible. Now, let's pivot to the psychological warfare that leverage wages on you. The trader who opened this position after the October 11th drop was likely driven by a powerful combination of FOMO, the fear of missing out, and the intoxicating allure of confirmation bias. They saw a dip, they believed in Ethereum's long-term story, and they constructed a narrative where they were the smart one, buying when others were fearful. Leverage amplified that narrative, turning a conviction into a potentially legendary bet. But this is where the human brain, with all its emotions and biases, collides with the cold, unfeeling logic of the market. When the trade started moving against them, other psychological demons took over. The first is the endowment effect, where you irrationally overvalue something simply because you own it. That losing position becomes your position, a part of your identity, making it incredibly difficult to cut the cord. Then there's the sunk cost fallacy, the feeling that you've already endured so much pain that you have to stick it out to make it worthwhile, leading you to potentially double down on a bad bet rather than admit defeat. Leverage magnifies every single one of these psychological vulnerabilities. A 5% drop isn't just a minor setback, it's a margin call, a flashing red warning sign that triggers primal fear and panic. This emotional turbulence completely clouds your judgment, making it nearly impossible to think rationally and often leading to the worst possible decisions at the worst possible time. So, what is the alternative? How do you participate in the potential of this volatile market without becoming the next cautionary tale? The answer lies not in avoiding risk altogether, but in managing it with a level of discipline that feels almost boring in comparison to the casino-like thrill of leverage. It starts with the foundational principle of only investing what you can truly afford to lose, capital that if entirely lost, would not fundamentally alter your quality of life. This alone removes the emotional desperation that leads to catastrophic mistakes. Secondly, embrace the power of simple, non-leveraged spot buying. When you buy the asset outright, you own it. There is no loan, no liquidation price, and no timer. This grants you the single most powerful advantage in any market, the advantage of time. You can afford to be wrong in the short term. You can afford to wait out the volatility, the bear markets, and the panic-driven sell-offs, because you are not a forced seller. Your hand is never forced by an algorithm. This patient, long-term approach is not as glamorous as posting screenshots of a 100x leverage trade, but it is the strategy that has built genuine, lasting wealth in the crypto space. It is the strategy that allows you to sleep soundly at night, knowing that a sudden 10% market flash crash is an opportunity, not an existential threat. It transforms you from a potential domino in the liquidation cascade into a steady observer who can actually capitalize on the fear and mistakes of others. Now, I have a final, crucial call to action for you. This video is meant to be more than just a story, it's meant to be a turning point. I want you to make a pledge to yourself in the comments below. Go down there right now and write out this exact sentence: my liquidation price is 0. Saying those words, typing them out, makes it real. It affirms your commitment to responsible trading and investing. It's a powerful statement that you are in control, not the algorithms, not the leverage, and not the market's whims. Let's build a community of smart, patient investors in the comments. I'll be reading them, and I can't wait to see your commitment. Thank you for watching.